Everyone keeps asking me, is Oscar Health an opportunity? Should I be buying, selling, or should I be holding my shares right now, Ronnie? Well, in this video, we're going to be breaking it all down. We're going to be talking about some recent news coming out around the stock. We're going to be talking about some politics that have heavy weight on the stocks. We're going to be talking about the valuation, some things they said in their last earnings call, and why a lot of those political things don't matter too much for 2026, as their leadership and Mark Bertolini has stated many times. And overall, we're just going to be asking the question, is it an opportunity right now? Or should we wait or find other investments out there? So without further ado, guys, I don't want to waste your time. Let's get into it. All I ask is that you smash that button, hit the subscribe button if you want to see more content like this, and find out if companies and stocks are an opportunity for you in your portfolios. Let's roll. So it doesn't take somebody 2 seconds to look at this chart and sit there and say, what the heck is going on the last year? Are we up almost 18% the last year? Yes. Is that good over a 1 year time? Yes. Has it been a crazy ride down to 10 or 11, $12, up to $20, down to $10, up to $20, down to 10? Yes. We've round tripped many times on the charts. We've round tripped many times on the stock, right? But why is it still an opportunity? And what is this telling us? It's telling us that there's an opportunity here while we are consolidating to be accumulating. Without watching the whole video, if you want my opinion and what I'm doing, I'm buying here and I'm buying leaps. And I've been very vocal about that, not just here on YouTube, but also on X. If you want to follow me over there, it's at the RonnieV Show. But why is it an opportunity when we've just been chopping sideways? How do we know it's an opportunity? Well, let's talk about it. Let's talk about the first thing here, the biggest news for Oscar Health. Now, see, Oscar Health relies pretty heavily on ACA subsidies. If you don't know what ACA subsidies are, they're essentially tax credits and the ability for lower income households to get health insurance at a cheaper cost. Now, getting health insurance at a cheaper cost is obviously good, but on the Republican side, they don't like it because they are saying that there's a lot of fraud with it and a lot of illegal immigrants are basically using it up and so forth. Again, not getting political. This isn't me saying this. This is simply what the Republicans are saying. So this is why they are so against it. But we have huge news coming out from this past week. We have House nudges Senate to find a deal with passage of ACA subsidy extension, meaning the House actually passed a 3-year ACA subsidy extension for ACA subsidies. What does that mean for Oscar? Well, Oscar is heavily reliant on ACA subsidies, or that's what people think. And we'll get into that in a little bit here in a minute. But I will say this stock, even at today at like $17 and some cents, is priced as though ACA subsidies will not pass. Because if ACA subsidies do pass the Senate and then they get a signed bill by the president, then this stock will probably see a 20 to 30% move in a single day. I know that sounds crazy, but you just have to realize that they're going after the ICHRA markets and they're also going after the ACA markets. And to be able to hold on to ACA subsidies and continue that cash flow and revenue for a little bit longer, 1, 2, 3 years, well, then that's going to do very well for the revenue and their bottom line. But Ronnie, why does this all matter? Why do I care about betting on whether or not these ACA subsidies are going to get extended or not? And that's just the thing. If you read other people and what they talk about with this stock, you would be convinced that this stock is ACA subsidies pass, hooray, ACA subsidies don't pass, oh no, this stock's going to zero. That's what people believe. But if we dig a little bit deeper, we'll soon and quickly find that even the management team isn't sitting here all doom and gloom and saying, oh no, we need to get these ACA subsidies passed or we're toast. That's not what they're saying at all. Let's take a direct note from the CEO, Mark Bertolini. The individual market is only source of affordable health coverage for 22 million people who power our economy, said Mark Bertolini. Our markets serve the small business, service, farming sectors, and can meet the healthcare needs of 100 million or more working people. Oscar is shaping the future of individual healthcare with affordable, innovative plans and a superior member experience. Our disciplined pricing and geographic expansion position us to be profitably grow market share, and we are confident in our ability to expand margins and return profitability in 2026. Now, he says all this, and there's many quotes out there from him on interviews, and there's many quotes from him during the earnings calls, literally saying that they are guiding without ACA subsidies in their guide at all. So they're saying ACA subsidies, if they pass, great. If they don't, it's okay. We're not going to miss all of our numbers because we're guiding for a world without ACA subsidies extension. And guess what? He just said they believe they'll be profitable, get back to profitability in 2026. Now, the reason that they became unprofitable in 2025 was really because of medical loss ratios absolutely exploded. So essentially, across the board, all health insurance companies typically see around 70 to 80 medical loss ratios. And towards basically the middle to the back end of the year, they absolutely exploded to 87, almost 90% for some medical loss ratios. And that's not good. The higher the medical loss ratios, the less money in the health insurance company's pocket. And it's a business, they need to make money, right? So when medical loss ratios are lower and they stay more consistent, well, then margins are typically better and they can be profitable. And they didn't price for those high medical loss ratios. Those kind of came out of left field. But in 2026, they are pricing for these medical loss ratios. So either they go up, which I don't believe happens. I don't believe they go higher than where they're at now because they're already very high historically. They go down back to where they were in 2024 and early 2025, and then they're going to see massive margin and massive profitability in 2026, or they come down to the mean around near 80 and they still see margins expand and they see profitability again in 2026. And again, this is all without ACA subsidies. But I do actually believe that ACA subsidies will pass. It passed the House and now it's going to the Senate. But why do you believe that ACA subsidies are going to pass, Ronnie? Well, it's because I actually don't believe they'll pass the 3-year that passed the House. I believe that the 3-year will go up to Senate. It'll get knocked down, and then they'll go in and then say, okay, we're going to tweak a couple things. We're going to 1 or 2 years of ACA subsidies extension. And I do believe that will actually pass. And the biggest reason is 80% of the users of Oscar Health are actually Republicans. So there are more Republicans actually using Oscar Health than there are actually Democrats. So it bodes well for members in House, members in Senate on the Republican side of things with midterms coming up this year. It makes a lot of sense for them to go ahead and not basically screw themselves over of winning back their seat. Because what we've been seeing this year already is that without ACA subsidies, people's health insurance for tens of millions of Americans are skyrocketing. So if they're able to fix that and able to pass ACA subsidies for 1 to 2 year extension, they would alleviate that. You wouldn't have, for this person to lose their job, lose their seat in the Senate or the House on the Republican side, because the Democrats are for it, for the whole Obamacare and ACA subsidies getting extended. So I don't believe the 3-year extension gets approved, but I do believe a 1 to 2 year extension of ACA subsidies does get approved. And if that happens, it's the cherry on top. They don't need ACA subsidies to be great and be profitable and to continue the business model that they have, which is a artificial intelligence, new age health insurance company with a CEO and Mark Bertolini that's run Aetna Group, which got bought out by CVS for tens of billions of dollars, and was next to Ray Dalio at Bridgewater. So he also knows the stock market. And in one of his interviews, he said in 2027, we expect to have 4-point-some% margins, and we expect to be at 12-point-some billion in revenue. And if we achieve that, or I think it was 14 billion in revenue, if we achieve that, then with a basic multiple or a lower conservative multiple, our stock price should be $45 to $55 per share. Now, he wasn't saying this to tell everybody like, hey, buy my stock, this is what it should be. He was just using his brain from Bridgewater and all that time around Wall Street sitting there saying, well, yeah, I mean, this is, again, the stock price is at $17 and some cents today. So once you realize that they don't need ACA subsidies, they've guided for 2026 without ACA subsidies. They're saying they're going to be profitable in 2026. You quickly realize that if ACA subsidies do get extended, you have massive, massive, massive growth. You could see $50 stock price for Oscar in 2026. It could be a massive year. And that'd be massive for me because Oscar Health and Zeta are my two biggest positions, guys. They're my two biggest positions. I am most confident and my highest conviction plays are Oscar and Zeta, guys. If you're new to this YouTube channel, welcome in. I just told you, I'm so bullish on Oscar and Zeta, and I've been talking about these stocks for over half a year. Oscar actually almost a year, Zeta about over 6 months now. So I'm super bullish on these companies for a slew of reasons. A lot of the reasons I just told you, and they're going to be able to profitable because ACA isn't going away. Affordable Care Act isn't going away. They're still seeing a lot of retention right now, even with premiums going a lot higher. They're seeing a lot of retention, some of the biggest in Texas. So they're seeing retention. They're not losing customers like crazy, like everybody thought. So that's getting out of the way. And then if you get ACA subsidies to extend, that's just a cherry on top, and they get to keep marching forward. But the biggest growth vector and the lever for them is the ICHRA markets. But why the ICHRA markets? The ICHRA markets, because think of how many Uber drivers out there. Think of how many people run their own business. Think of how many people are self-employed. Think of how many people do Uber Eats or DoorDash or so on and so forth. They need insurance for themselves and their families too. And that's where the ICHRA markets come in. And they're partnering with local grocery stores and, basically coming into your neighborhood and say, we're Oscar Health. We can help you with health insurance. Even if you don't have a normal 9-to-5 job, you are working for yourself or Uber or whatever. So that's where that can really come in. And that's expected to continue to grow, right? Social media influencers, so on and so forth. So we talked about the recent news. We talked about the stock price. Recently, the stock started taking off because UBS came out and they raised from sell. They went from a $12 price target to $17, and we were down to like $13 or something. So obviously the stock's running then. They also had initiated Equal Stevens and Company of $17 per share. So that's where we're about at right now, right? And a couple other things, if you didn't know, the Kushner, Joshua Kushner, he is on the board as well, or Jared Kushner. Basically, the I don't know them that well, but the Kushner brothers, the one brother who's not the closest, Trump, is basically on the board of Oscar. So he's paired with his brother, and I don't know if they're not, but maybe they do. And if they just another bullish thing that kind of gets us over the hump for ACA subsidies to possibly extend. But anyways, I digress. And actually, I wanted to show you this clip before we actually go to valuesnapshot.io and go through the valuation and go through whether or not there's an opportunity through my opportunity matrix 3Ds to investing checklist. So let's check this out. I think we're going to watch the exact clip where the CEO stated a conservative fair value of $45 to $55 per share in 2027. This is from around July timeframe of 2025, so about 6 months ago. But he's continuously said pretty much the same thing in earnings calls. So let's give this a listen.
Where is the business now on this journey to go? The stock price is higher. I think it's on 16. It probably fluctuates, but 16 share. You got a market cap of about $4 billion. How far along are you on your journey now?
We're through in 2025. Our objective is to have so we made money in 24 for the first time. We made adjusted EBITDA in 23, which is what we told the street. But in 24, we actually made EBIT. We made real money you can count, right? Instead of funny. And so that kicked it off. This next, we've promised 2.5% margins to the street in our earnings through the year, and growth of up to 11 billion in premium. Those two numbers matter. 11 billion at 2.5% margins in the insurance industry generates a $5.5 billion market cap. We're at 4 point something right now, 4 point low, right? So that's one piece. At 5% margins, you get a 1x of revenue. And so by 27, what we committed to the street is we're going to have 5% margins, real margins, not EBITDA, EBIT, and we're going to have 14 billion in revenue. that makes the stock price of the company somewhere between $45 and $55 a share, depending on the PE multiple from where we are today.
Where is the
Massive, guys. So I look at that out of the way and we'll see, some news and where this company's going. Now, is this actually an opportunity? So we come over to valuesnapshot.io. If you want, you can get a 7-day free trial with this right now. It's a complete valuation analyzer. We have financial charts. We have AI one-pagers. You can do the whole thing. And you can even come down here and look at the opportunity matrix. It's a full checklist. And like I said, 7-day free trial, all yours. You can even come over and get some free runs of the valuations. We got DCF EPS, rule of 40, PEG ratio. You basically can do all of your research on one stock in one consistent flow on our website, and makes it really easy. And honestly, it's made my life a lot easier. Instead of using my clunky Excel sheet, now I'm using this and it's 10 times better. So this is my opportunity matrix. This is the 3 Ds to investing. So basically we have discovery. So discovering the stock is pillar 1. So we go through and we can get a score up to 11. So we're going to ask these questions and I'm going to answer them, give you my opinion. Is the company misunderstood or mispriced? Yes, it is. When we run simple valuations, we can see that this company is mispriced. When we look and listen to people talk about this company, we understand that it's misunderstood. It's misunderstood because people think that if ACA subsidies go away and extended, this company will go to zero. They'll die. They're not going to do anything. They're not worth an investment. Even though when you run conservative assumptions based on what they're projecting, you still get a buy on this stock. I'll do that in a minute. Is there a clear catalyst or fear creating opportunity? Yes, the fear is that ACA subsidies won't get extended and that they're going to lose massive amounts of people, which has already started to show that that's not true, as they are getting consistent people signing up again, converting as well with the ACA subsidy or without ACA subsidies, and the premium still being higher. The clear catalyst, the closed catalyst is ACA subsidies getting extended. The catalyst beyond that is just them continuing to come in with earnings coming up and continue to prove that they're going to beat out earnings and be profitable. Does the business model have long-term durability? Health insurance is one of the stickiest business models. It's one of the, it's a dinosaur sector in view, this AI-powered view. And I do believe that they're going to continue to be able to take away market share, especially with somebody that's been in the business for a very long time in the health insurance industry and wants to truly change it for the better. So I do believe that it's a long-term business model, long-term durability. So we got 3 for 3 on discovery. Great. Data. Are revenues and earnings growing? Yes, they are. So revenues actually accelerated this year and they're projected to continue to accelerate over the next few years. Are margins stable or expanding? Margins are stable. They had a rickety 2025, but again, we know why. Medical loss ratios went up. It wasn't only Oscar that was affected by this. It was everybody affected by this. It was United Healthcare, which is the company in the world for health insurance. It was everybody. So we'll be fair and we'll say margins are not stable and they're not expanding right now. But we can very easily click this yes after a couple of quarters in 2026. Is cash flow strong or improving? Yes, they have great free cash flow. And if you've been following me long enough, free cash flow is the lifeblood of a business. And I love calculating a company's fair value based off of it. Is valuation attractive compared to, yes, it's very attractive compared to UNH, CNC, Centene Group, and others. Okay, so 3 or 4 on data. Good, pretty good. What about the direction? We thought about consolidation earlier. Now we have our indicator, the matrix indicator, and the suite that comes with it, and kind of tells us the overall movement of a stock. And we'll kind of that here before we answer those questions. So if we chart, let's go to Algo Monthly. And what do we see? If you don't know technicals that well, it's okay. But basically, it is a cup and handle. So a cup is where it comes down and comes back up, rejects at a certain point, comes back down, and then is coming back up again. We have this consolidation since early 2024 that we haven't been able to break out over $24 per share. Let me just tell you, when we do break out over $24 per share, you are going to see price appreciation like crazy. You're going to just see this stock continue to climb. Oh my gosh. Higher, 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 up to 37, up to 45, right around 45 to 55, saying that the fair value is. You have this massive volume shelf here. You have your 21 EMA, or sorry, your 13 EMA and your 13 EMA and your 21 EMA continue to hold price steady. So you're still in this uptrend right here since these lows. And you saw the same thing back here. You saw this consolidation, and then you saw price appreciation. Now you're seeing consolidation. And I believe you're going to see price appreciation here eventually, soon, right? And basically, once we get a breakout over here, we'll be good to go. Right now, based on the matrix, we are, kind of no man's land. This is a very choppy stock. We're not up. We're just kind of topping here in the middle and trying to figure out where we want to. The low is down here at $11.22. The high is up here at $23.56. So we're basically just going to continue to chop in here. And I believe this is a great area to continue to buy, obviously in the lower half of this box. So basically sub to be buying. And then if you want to trim before we maybe possibly reject again, you're looking at $19 to $24 range. Okay, so we see this. Now let's go back and answer the questions. Is the trend up on higher time frames? Well, we just talked about it. The trend is still up. We are consolidating, but is still up since 2022. We're not in a downtrend. We are in an uptrend. If you just draw two simple lines like that, you are still in an uptrend here, right? You're at the bottom of the trend. So yes, we are still in an uptrend. Is the stock not overbought? I know it's a bit confusing, but is the stock overbought? Has it gone on this crazy run? Is it down towards the low of the trend? Well, it's down towards the low of the trend. So it's not overbought. Is it a falling knife? A falling knife is simply a stock that just keeps going down and down and down. It seems like it can't catch a bounce or a move higher at all. No, it's not a falling knife. Does the matrix indicator show strength or breakout potential? Yeah, we just showed it. It does show strength and a breakout potential. We're not there yet, but it does show that it can happen. And we're not bearish. So yes, direction is clean. So we get 10 of 11 score. We get a rating of a buy. We get Oscar 10, 11 score. And we basically get this saying, okay, guess what? We have an opportunity here. We have an opportunity here we have a solid company if you believe in it, right? Just because you answer these questions all yes, you still have to believe in the company and have conviction. So look at financial charts real quick. So we can go over here, look at Oscar, and we will go ahead and look at let's look at the quarterly. So the quarterly has been a bit, look at trailing 12 month. So trailing 12 month, we see revenue continue to climb higher. We saw some blips down on net income, but again, we should see profitability in 2026 based on what the leadership is saying. And the free cash flow margins went from 3.5%, and they're basically right around this 6 to 10% range. I do believe those will spin back up. Also with net margins. Net margins were about 0.4, got to a high of 1.2%. And remember, he's saying for 2026, he believes they'll have 2.5% of net margins and then 5% of net margins in 2027. So you can obviously see how massive that would be for this company. Gross and operating profit are continuing to climb higher. And you can actually expand this if you wanted to. Growth and profit and operating margin are continuing to expand higher. EBITDA, like I said, it had a pull down due to MLR ratios. But again, if you understand that and you believe that the average is 80 and that we will see a mean reversion back to the mean, then you understand that we'll be good to go. She's looking good. One of the things I love most, $2.15 billion in cash and only $686 million in debt. Love to see it. In shares outstanding, they're not climbing like crazy. They're not going up. They're just kind of like steadily in line here. Earnings per share, they should be able to flip this back and get by positive earnings per share, revenue per share, debt to equity. But let's go over it now to Value Analyzer, where we're going to look at Oscar and see, okay, based on a discounted cash flow, EPS, Rule of 40, and PEG ratio, is this undervalued? So we can first see that they're doing about $11.289 million in revenue. Their revenue growth isn't going to be 71%. It's been 89%, 71, and 56.5. I would say let's be conservative and let's say it grows 15%. Free cash flow margins have been 4.6, 10.4, and then 6.5. Let's just leave it at 6.5. And let's go to a 10 terminal fair value for 5 years And you know what? Let's just say they grow 10% and they only have 5%. Okay. You know what? Let's beat them up even more. Let's say they get back down to, so this company, next 5 years, are only going to grow revenue by 10%. Their free cash flow margin is going to be sub 5%. Their terminal value is going to be 10, which their current is 7, and their 5-year average is 175. You know what? Let's give them a 7. Give them a 7. Fine. Give them a 5. Give them a 5. 5 lower than it is right now, and then a 10% discount rate. Look at that. It's a buy today. I literally beat the crap up out of this name, and it's a buy today. 16.5% undervalued, $20.57 intrinsic value on this name. Now let's actually put some realistic growth rates in here. Because if you look over here at Seeking Alpha, 31% in 2025, 6%, 10%, 7% over the next basically 3 years. And again, that's without ACA subsidies. So let's go in here and say the average, let's just say 10%, because that's still right around 10%. They're only going to grow 10%, but their free cash flow margins, let's say they actually stay at 6.5% instead of going back down to a 3-year average low. And then let's give them their current free cash flow multiple of today. And then you see a 98% intrinsic value, undervalued percentage. $35 is fair value on this name, and we're currently sitting at $17.67. Implied CAGR is 13 cents per year, basically. Now, if we go over to EPS, what are we going to see? Well, we're going to get rid of this because obviously this year they went down, but they were at 10 cents of GAAP profitability. So we'll start off at 10 cents. You see they're expected to have growth. So I believe they'll get back to 10 cents. And then we'll see somewhere between 56, really 71% growth from 10 cents. I believe they're going to get to a plus in basically year 3. So this is going to be more so like 150%. Maybe let's go 120% actually. 120%. Let's give them a multiple of like 10. It up, and we get 81% undervalued, $31.98, current $17.67, 81%. Upside, 23.9% implied compounding annual growth rate with that. And then rule of 40, growth rate of profit margins of 6.5%. Obviously, your rule of very low, very, very low. But this isn't a super big growth company. Even though if ACA said they were going to see way more growth, probably 20% plus. PEG ratio, it's going to be, let's give it a 10 here. And then let's say, again, they go 125% growth, or just take their last growth, deeply undervalued at 0.18. At this forward PE, definitely not. At this 5-year PE, definitely not. But if we give them a reasonable 20 PE or something, then yeah, they're deeply undervalued on the PEG ratio too. Then we can simply go here, compare all models. We can share model snapshot, and we can see it right there, guys. We can zoom in and we can see it is a strong buy. The average upside is 90%. Current price is $17.67. Based on discounted cash flow model, $35 fair value. Based on EPS model, $32 fair value, believe those assumptions. Rule of 40, it's not really a growth stock, so we're not really going to be valuing this on rule of 40. And then PEG ratio, it's a 0.35. Very, very handsome and looking great. So overall, is this an opportunity? Yes. Yes, it is. I do believe it's an opportunity. I do believe it's a buy today if you believe those assumptions. If you understand that they don't need ACA subsidies to continue to thrive as a business. But at the end of the day, we're all adults and we're all going to make our own moves with our own money. So this isn't a pitch for the stock. This is just me telling you my opinion on the stock, my opinion on the future of this company and where I think things are going, and my conservative projections and assumptions going forward, and why I continue to buy this stock and believe that it's going to see massive price appreciation, maybe not in 2026, but 2027 and beyond if ACA subsidies don't get extended. But believe it or not, I think they're going to continue to prove it and crush earnings. And as you see, those ratios come down in 2026, they're going to see higher margins and they're going to continue to crush it. And then Wall Street's going to say, oh, wow, this thing's very, very, very undervalued. And it is very, very, very undervalued right now. And again, that's without ACA subsidies. They will be growing 10% of ACA subsidies get extended. They'll be growing more, 15, 20, maybe more % per year, their revenue, and their margins will get a lot better too. So that's all I got. That's Oscar. If you haven't already, do me a favor, hit that like button, hit the subscribe button. These videos take a long time for me to put together. If you want deep dives into these before anybody else gets them, come join my community, the High Five Collective. Whether you want to be an investor, I have an investing community, or whether you want to be a trader, I have a trading community where we focus more so on that direction piece and not so much the fundamental piece. Or with the investing, we focus on all three. So whatever you're looking for, we got a little bit of everything for everybody in different Discords. That way we keep the investing and trading separate, because it is a very separate thing. I always say left brain for investing, right brain for trading. I'm a jack of all trades. I do both of them, but I really enjoy it and I see solid success with both. So I'm able to separate it. Not everybody is. So that's just how it is. Appreciate you all joining me for this video. Hope you guys have a great day. And yeah, I will catch you guys in the next one. Talk to you later.